Hey, what's going on, guys? Ray Shapley, Where to Live in Austin. In this video today, I want to talk a little bit about the interest rates, what's going on with them, what we need to be doing in terms of, should we be taking action on these? Should we be refinancing, locking in our rates? Should we be waiting? And just kind of get behind what's causing it all. Now, this is definitely not, or it's definitely a little bit out of my wheelhouse. So I brought in John Burnam, who is my personal lender, kind of my go-to guy in these situations. So, John, thanks for coming on Where to Live in Austin.
I appreciate it. Thanks, Ray. Always a pleasure.
You bet, man. So we were just talking before we started recording. By the way, John, and folks out there, I don't know what I'm going to call this video yet. I'll come up with like a clever title, but I just want to kind of dig into the issues. So, John, we were just talking about this is one of the craziest days you've had in a long time, right?
Yes, it is. So,
Tell
no.
me about it.
Well, first of all, the stock market has been right around a 2,000 point loss today. Of course, it's teetered and moved around, but let's just call it 2,000 points, about 7 or 8% drop today. What that's done is it's really made the bond market act pretty in a strong manner. So a lot of money coming out of stocks, a lot of money going into bonds. When bonds are being purchased, that makes mortgage rates come down. So we were already at record levels before today, and now we're seeing some numbers I've quite honestly never seen before in my 19-year career. So
Wow.
it's
Okay.
pretty interesting.
Okay. So, yeah, I think a lot of folks have the impression, when they see the Fed lowering rates, and while everything is somewhat connected, but they think when the Fed's lowering rates, that translates directly into mortgages, but that's not really the case, is it?
No, it's not at all. In fact, the Fed cutting rates, they're cutting the short-term rates. They're cutting the overnight lending rate, which can also have effect on prime. It can have effect on home equity lines of credit. It can have an effect on car loans, shorter term loans, construction lending, things of that nature. It does not directly impact mortgage rates at all. However, cutting the short-term rates can make the markets react differently, make the stock market react. Well, there's a lot of global things going on that have affected the stock market, but it can stimulate the economy in many cases when the Fed cuts rates, which can actually make the stock market do well, which can take money out of bonds, and it can actually cause mortgage rates to go up. We have not seen that recently. We've still seen mortgage rates come down, even though the Fed cut rates. But again, that direct correlation isn't there. It's just all the different global factors that are happening right now has kept mortgage rates down.
Yeah, so I'm watching just briefly, but I'm looking in. I'm seeing oil tanking. I'm seeing, and I'm sure that that's connected to the virus and travel, and it kind of all connects. But for folks who are out there who are like, in one of a couple categories, either saying, "Gosh, I thought I had a good rate, but should I refinance? I know there's going to be some cost. I just bought my home last year or something like that." And then also the folks who are maybe thinking about buying, but maybe a few months down the road, let's talk about these different scenarios, or people who are under contract trying to figure out when to lock. So let's just take these one by one,
Sure.
kind of address like how would you play this? Obviously, neither of us has a crystal ball when it comes to what's coming, but talk to me about where rates are today and what that means for folks refinancing. What would you do? Would you wait a little bit? Would you
Sure.
pull the trigger?
Well, I think it comes down to appetite for risk. So if you're watching this and you're a lower risk person, lower risk averse, I would say you grab the rate. They're at all time lows. Be just incredibly thankful that you're getting this incredibly. No matter who you're financing with, lock in your interest rate. Yes, I understand rates could go lower. They could. We'll talk about that in a second. However, if you want to check that box and really not have to worry about floating, what we call floating in the business, where you're not locked. The opposite of lock is float. Um, then you lock. If you're a little more risk, or I guess you want to take on a little more risk, then you could take on a float position right now, which I'm just gauging when I'm talking to my clients. I'm being very, very transparent with them. I want the lock conversation to be a two-way conversation. Hey, here's where we are. We're at, let's just say 2.5% on a 15 year today, or 3.1 on a 30 year, or whatever the numbers are, which those numbers are out there depending on your financial situation. And so let's just say we're at 2.5% on a 15-year fixed. That is historically low. I've actually, in my 19-year career, never done an interest rate lock an interest rate that low ever. So if you're risk averse and you're seeing these all-time low rates, you got to grab it. I think you grab it, you check the box, you just breathe easy. If they continue to go lower, one question to ask your lender is, do they have a relock policy or do they have a rate renegotiation policy? Because if you have a rate renegotiation policy, and we do, depending on the movement in the market, if we lock and the rates continue to improve, then we'll relock you lower. Maybe not at the absolute floor, but you're going to get some rate improvement. Okay, but if we lock and the rates go up, then we're all going to be excited and happy and breathe easy that we locked. So that's one strategy is, hey, I'm more of a risk averse person. Let's lock it. Okay. If you really are trying to catch it at the bottom, which again, nobody knows where that is until it's behind us. But if you're trying to catch it at the bottom, then I'm having the conversation with my clients about cautiously floating the loan. Okay. Here's how that works. You're going to do everything that you normally would do on your application. Submit your financials, submit your pay stubs, W-2s, tax returns, get the appraisal done if one is necessary. Have an understanding with your lender. What is your ceiling that you want for your rate? Okay. Let's say it's 3.25 on a 30-year fix. That's what's being quoted, and you don't want to do anything higher than that. Then be on a two-way understanding with your lender so that when the rate is ready to lock and it actually is better than that, the lender can lock it. If rates start to turn, and believe me, when they go quickly. Like the oil prices today going down, rates can go up that fast. It's really remarkable how quickly it can shift. So be ready, and then we can lock our entire pipeline in 45 minutes. And that's basically how you have to be positioned. So this cautiously floating policy might work well. However, if lenders get too busy and they can't pay attention to your loan, that's something to consider, and you might get left in the cold if rates go back up.
Right. Okay. Okay. So let me throw us on a different view here. Sorry. There we go. Gallery view. So let me ask you about this because, I think that a lot of people are kind of looking at these rates thinking, oh, I bought at 3.9, I bought at 3.7, it's 3.2 now, whatever it is. What's that really mean to me in terms of a payment? What is there some quick math, a quick formula you can give folks to get an idea of what
Sure.
this means in real dollars and cents?
Yeah, I mean the median home price in Austin is just over 300,000. So let's just use 300,000 as a loan amount for example. A lot of folks are over that, some are under, but as a general rule, if you're at 4% now and you're going to lower your rate to 3%, of course that's a 1% variance. It's basically $3,000 a year in interest, right? 1% of 300,000. So roughly $200 to $250 a month. So if it's going to cost you $3,000 to refinance and you're going to save $3,000 in the first year, then it's a 1-year break even. I would say do that loan, right? That's a pretty good make sense loan. If it's going to cost you $8,000 to refinance and you're going to save $100 a month, that's 80 months to break even, right? That might be a little harder to justify. Right. So the interest rates look really great, but I have some clients that are in that mid to high threes, and if their loan amount is fairly low, and I'll just say under 200,000, sometimes it's hard to justify the costs because a lot of the costs are fixed costs. So you've got processing fees, underwriting, appraisal, title, may have a survey. You've got these fixed, $3,000, $4,000, $5,000 worth of closing costs, and sometimes it's hard to justify, refinancing for maybe just a half a point lower or 3/4 of a point lower. But the quick math is take your loan amount, take your current rate, and do the delta between your current rate and let's just say 3.25 to 3.5. That's kind of where rates are right now today. That difference in spread, you can multiply times your loan amount, the percentage, and get a savings and do a quick calculation.
Okay. Now, this is really tied into the stock market. So or equities in general. But if one wants to kind of understand what's pushing and pulling this thing, it's a pretty safe assumption to say, if the stock market starts recovering for an extended period of time, we could see rates start going back up pretty quickly.
No question.
Okay.
No question. Because the correlation you're going to see there is the money flowing back into the stock market is most likely going to take money out of the bond market. Stocks and bonds typically move in opposite directions, although in recent months they've moved in more of in alignment. The stock market going down, the bond market's also been strong, which has brought rates down. But what you'll see typically is money flow into stocks. You'll see the money coming out of bonds. If investors are selling bonds, then the prices are coming down, the yields are going up, and the rates will come back up. So stock market's going up, interest rates, our rates, right, mortgage rates would typically come back up. And
Got
again,
it.
it can happen quickly. Yeah.
So if someone's out looking or thinking about buying in the near future, depending on their price point, uh, rates they can obviously go lower. They can stay the same. They can go higher, but they're, I think for some people, I think we're seeing this in our market. I think it's causing people to take action now rather than wait, simply
For sure.
because sometimes if you're in that $400,000 or $500,000 range, just the difference alone might be you might be able to buy a larger house closer in, whatever it is you're after. You could kind of bump up a notch or two and have the same payment, right?
That's right. Yeah, typically the math equation you can do is a 10% increase in price and 1% lower interest rate will be about the same payment. So give me an example. If you're looking at a $300,000 house a year ago at 4.5%, and now that price is 330,000, 10% higher, and the rate's at 3.5 instead of 4.5, it's basically going to be give or take about the same payment. So it increases your purchase power if you have been waiting, and maybe you can buy that little, stretch your budget a little bit, or sales price surge, I should say, to keep the same budget, same payment.
Got it. Got it. So going back to the refinance, if someone's looking at this trying to make a decision, what in your mind, and I know this is all opinion, um, what is the amount of time to break even? Because you're going to outlay closing costs when you do this. What's the amount of time to break even that you say thumbs up, and where does it break and you go thumbs down in terms of that?
Well, some of the loan programs actually set the parameter for us. Like, for instance, a VA loan, it's a 36-month break even or less. So for our veteran clients out there, if you're going to refinance, you have to be at a 36-month break even
Okay.
for us to do what's called a streamline refinance. So let's just use that as a tool. Maybe it's 3 years. But if you know you're going to sell in 2 to 3 years, I don't know that I'd take on a refinance right now, unless you can structure it in a way where the lender pays your closing costs, and there are loans like that. And you'll see no closing cost refinances out there. They do exist. What is happening on that is the lender is basically giving you a slightly above market rate, and they're creating some profit through that above market rate, taking that profit and paying your closing costs. Because the closing costs don't go away. There's always title fees. There may or may not be an appraisal fee, but there's always some transaction costs that have to get accounted for. But I like to see break evens between 1 and 2 years. I think 3 is on the high side. But then again, I had a client recently that it was 5 years, but they said they're never going to move again, and they don't really want to touch the loan again. So
Okay.
they're going to do it, get on, check the box, and move on down the road. Hopefully, never refinance again. So it does depend on how long you're going to be in the home, but I'd say generally speaking, 1 to 3 years.
Okay. So let me ask you to get your crystal ball out real quick,
Yeah. All
and
right.
let's talk about the coming weeks. Obviously, we don't know. I don't think anyone understands the extent that the virus is going to affect the economy. There's a bit of a domino effect. Some people say this is just going to blow over. It's nothing. Others say this is just the beginning. But you've been doing this a while. What would you guess in terms of, obviously there's going to be volatility in markets, but rate wise, do you think as this year plays out, we're going to continue to see pretty low rates? Uh, I think that it's tied to this kind of pandemic and all that goes on with it, and as that recovers, rates will recover. But at some point, if travel's been down long enough and companies are laying off people as a result, and all these things, this domino effect, all of a sudden we start entering kind of this idea of a recession and things like that. I probably way overcomplicated that question, but where do you see this thing kind of, how do you see it playing out? Best guess, won't hold you to it.
Well, following some industry experts, there are quite a few mortgage rate industry experts that are predicting that rates will continue to dip just a little bit. However, I will say this, if you follow the 10-year yield, and I think today it hit somewhere in the zero point 0.4 range for the first time ever. Actually, I think we're under 1% for the first time ever, and then it continued to fall. Mortgage rates perceivably have been tied to the 10-year treasury. That's not true. They're tied to something called the universal mortgage-backed security, which is a mortgage-backed security. It's a bond that trades on Wall Street, right? And so that universal mortgage-backed security, the buying and selling of that particular bond is what causes mortgage rates to go up or down. But the 10-year treasury has been a pretty good indicator in the past. If you notice the last couple of business days from late last week to today, the 10-year treasury has fallen way more than rates have fallen. And so what I see, and I've talked to some industry experts on this, especially our CEO of our company, has said there's actually kind of a floor there with 30-year fixed mortgages. We may not see very, very much of a dip moving forward, even though the bond yields continue to drop and we should go lower. There's a floor there because the investors still have to make money where they're pricing these loans at. So again, are we waiting for rates to go lower when they're already at their lowest of all time? I wouldn't, if I were a buyer right now, I have a lock bias. And I tell all my buyers, I have a lock bias. That's my personal professional opinion. I don't let any of my buyers float unless they tell me they want to float, right? We're on the same page with that. My advice to them is lock. Refinances are a little different animal because you can wait for the right mix of rate and cost and break even to make it make sense for you. Purchases, I don't think you want to mess around with that. You got a closing date, you got a moving van that's going to be
Contract,
pulling away from the house right after closing. So we got to make sure that we're hitting those closing dates and not really waiting for the day before closing, still trying to figure out, is it going to be lower? Can we relock? Can we, it's just, I think you take it, you grab it, and we're in unprecedented time. So we should be super grateful that we are where we are on rates and really not get overly greedy. It's human nature. I know we all want the bottom, but it's just hard to catch it, and we don't really know where that is till it's gone.
Cool. So best guess, just based on what you said, it sounds like there is a floor on interest rates. That's something I've always wondered about. Honestly, I never thought we'd see the low threes again. Do you think it could go sub, into the twos in general,
I
or?
I do, based on what some industry experts have said. But again, getting it, like, we can actually get into the twos now on a
Okay.
30-year fixed. It's all function of cost. So I think our rate sheet today goes down to 2.75% on a 30-year fix. So technically, I could lock that loan. Now there's a cost associated with that buy down, right?
Yep.
So that we'd have to factor in, does that make sense? But technically, we're there. We're just not there where the consumer wants us to be, which is the no points, the no buy down loan. I don't want to pay extra to get that rate. I just want that rate to be my chosen rate. And for those of you that may not understand how the rate and cost works, but every single interest rate has an associated cost. So the lower the rate, the higher the cost. The higher the rate, the lower the cost. So let's just say the happy medium today is 3.25 or 3.1, depending on what your qualifications are: loan to value, credit score, sales price, loan amount, all that stuff. So if we're already in the twos on the rate sheet with a cost, we may see that cost decrease, which would make it more palatable for a buyer to say, yeah, I'll take 2.875 because it only costs X, whatever that cost is.
Mm-hmm.
Will we see it to where there's no cost at all? I don't know. It'd be a pretty big swing right now with the market, because again, that 10-year, we're not following the 10-year directly, but the 10-year yield, let's say it's 0.5%. If it goes to zero, that would be 0.5% in yield that you could argue could decrease on mortgage bonds. Well, the yield is not the rate. The rate is associated with the cost. So the yield would make the cost go down 0.5%, which might only change the rate an eighth. And so what I mean by that is the 10-year yield could go to zero, but the mortgage rates may only move an eighth of a point, or a quarter, which would get us kind of that maybe 3%, 2.9 to
Yep.
3.1, something like that.
With no cost.
So it's pretty complex, but from a price cost standpoint and yield standpoint, all those numbers really move together. And we'll just have to wait and see what the appetite for mortgage bonds is, because we are flooding the market with mortgage bonds right now. Supply and demand means we're going to be over inventory, if you will, of closed mortgage-backed securities could decrease the demand for investors that want to buy those, which could cause rates to spike. So
Got it. So that made me think. The other day we were talking, and you were saying that your company's seeing some of its biggest days ever, right? So talk to me a little bit about that. What's going on there?
yeah, what we're seeing right now, the lock volume is unlike anything we've ever seen before. We're running about 3 to 4 times per day what our biggest lock day was prior to this mortgage rate drop. So to
Wow.
put that in perspective, our biggest day ever before this past week was X, and now we're locking 3X on a daily basis, 3 times what our biggest day was ever before this. So if we're doing that, our competitors are doing that, the industry is doing that. And if you run our numbers out over the next 12 months, if we kept this volume up, we would probably quadruple or more our volume, probably 4 or 5 or 6 times what we closed last year. And that's just, to grow at that pace is just unheard of. So again, flooding that market with mortgage bonds, at some point it will be over flooded, and it will cause the demand to decrease for those bonds. It could spike the rates.
Okay, so that's another factor that can actually kind of bounce off this floor. We don't know when that's going to happen. Obviously, there's a threshold, but that's something to be mindful of. So, John, thank you so much. Let me ask you, if folks are watching this, if they have more questions, can I put your contact info below? Can they reach out to you?
Please do.
Okay,
Love to talk to them.
guys. Thanks so much for watching Where to Live in Austin. John, thanks for being on the show, and I will see you on the next one.
My pleasure. Thanks a lot. Take
Thanks.
care.